morning, everybody. It is Friday, January 20th. But most importantly, you need to know that today is OPEX Friday. Today's options expiration Friday. Every third Friday of every month, you get options expiration. That's where all the big boys are. It's where all the big money is. And the majority is all based and concentrated on the open. Prior to the open, you have expirations. At the closing bell today, you have expirations. Those are what we trade. The big boys, they trade this. I showed you earlier in the week. There was that big straddle at 4,000. Covering here really quick because I just want to go over this fast. Tuesday's trade. Monday was a holiday. Tuesday's trade that we took there on the 4,005, 4,000, 50% on the spread. Wednesday, same thing, 40-10, 40,000, 150%. Yesterday, my majority focus was on that 38.85, 38.90 for the risk takers, almost 100%. I believe that it did actually break 100% when we got that little dip below the 50 retracement line. But from where I tracked it, it was at 240. And, again, today, the trade of the week is going to be expiring. There's absolutely no chance in hell that thing's coming close. It's already gone. Full credit's going to be on that. That's another 150% for the week. That's just the four spreads right there. We've had some great SPY puts. We had the SPY calls going into this week. It's been a great week. So the goal of today's video is don't go and fuck it up on a Friday. Last two Fridays, guys have been screwing things up because they missed out on trades the week because those were great weeks as well. Don't do it because I'm right there in front of you. Don't do it. It's Friday. I'm going to go over this with you, but before we go over a couple of things that I'm going to show you, this is the one and only trade I would have on my screen for today if I was going to be doing a credit spread. And that would be buying the 38.50 put and selling the 38.55 put. 38.54.90 is where your minus 20% bear market line is. All right. We haven't been to it in a while. We might not be to it again, but that's where it's at. On top of that, your January open is 38.53.29. So meaning to say, we break below 38.53.29, we are into a negative month. And I'll show you as well when we come on to a few other things here. We've got 3 red closes in a row this week. Today, should it close below the open, which is basically right where we closed yesterday, would be 4 red closes in a week. We had 4 back during December's OPEX. OPEX, you had 3 in a row, Wednesday, Thursday, Friday. After we had hit that 4,196, which everybody remembers what that 4,196 represented. And then we closed red again on Friday, and then we were going green, red, green, red, green, red as we sat down there in the 3,800s. Here we are. We had a little bit of a dip, and I want you to see this. You had a dip here to 38.98.85 to end the day yesterday. And that is to screw all of the people that had the 3,900 calls so that they can't get paid on the big institutions and the OPEX. One of the other things that I want to highlight here is you'll see here in blue, which is my range column. We only traded in a 37-point range, less than 40 points. We traded less than 40 points on Tuesday. We traded less than 40 points in the beginning of the month. We had 2 40-point ranges during the course of last month. And what I had shown in the beginning of the year when I was talking about how this year starts to look good, the green closes, the red closes, obviously this 4 green closes in a row last week was very, very good. But want to see the ranges start tightening up so that 50 points and 60 points is a once in a while occasion. And we start trading back in that 25 and 30 point range. And that's when the volatility tends to, remove itself from the market, and the bulls actually do have control. So again, just a point that I'm pointing out there for something to see. But now that I've wasted enough of your Friday morning, again, that's the trade that I will be having on the screen, and the only one that I would even mess around with. I like this for next week's trade of the week. I just don't like that it's not giving enough credit right now. So kind of going to wait on that for a little bit. But I do like it for next week. It's only giving around $1.30. Nothing wrong with, 35%. I just want to see what we've got, and, I'll deal with that over the weekend. So anyway, I am pulling up here on for you one of my big TVs. This is one of my big TVs that I have on in front of me. I've got 3 of them. This is the one I have over on the left. And I'm bringing you here for this specific reason. This is the Dow Jones, the 4-hour time frame. And I want you to see here how the 4-hour time frame is very oversold. I'll bring you over here to the SPX. And the SPX, again, same thing. 4-hour, very oversold. Come over here onto the NASDAQ. And again, the exact same thing on the NASDAQ, where your 4-hour is very oversold. And what that tells me is you are risking a hell of a lot of money if you are going to be playing on the flip side, because you're not getting much downside anymore from this. And bring you over here to the legs of the market. This is your QQQ. We're only looking at a 15-day move coming off of that 259 back there in December, right after Christmas. And you can see here, it's kind of lethargic, even though, you did get a nice little run, 25 points. And we're hanging here at the 50 retracement to the December 2018 lows. Where we're resisting is the 50 retracement to the COVID lows. And we do have this gap to be filled here from December. 200-day moving average way up here at 294. 50% of the S&P 500 reports earnings next week. And all of your major tech reports next week. Zoom this out a little bit. This is what your 90-day looks like coming over here off of your September highs. This was a gap down after that September CPI fuck up. 297 you can see here is a problem. 294 you can see is a problem. But you can see here how we've really just gone nowhere on this, waiting for earnings to come out. Bring you out here into a much wider picture so you see what we're looking at. For me, I see this as a completed 1, 2, 3, 4, 5 waves down on the NASDAQ. All we're doing here is just basically setting ourselves up, which you can see with a blind eye, an inverted head and shoulders to push back up to that 330 level. It's right there. It's right in front of everything. But you're not going to get to 330 until you get above 286. And you're not going to get above 286 until you get above 278. 278, 279, then you start working for that 297, then you start working yourself up into those 300s and this big gap over here from September, 303, 310. This is the major wide view that I have with a cheap VIX. I'm going to put it out there later today. What the March or even June 330 calls look like. SPY here, again, it's a video game. It's a video game. It's a video game. What we had here right there, right at 11:30 in the morning yesterday, was the dip right to the 50 retracement down from those December lows. We stayed down here for a couple of wicks. They stopped everybody out. And now where you're trading right there is that 50 retracement back from the August highs to the October lows. We break above 389. I see no reason to expect anything more than 393.75, 393 from that Friday low last week. Right up in that area at 393. That's the maximum best case scenario. Leprechaun riding a unicorn doing shots of whiskey look. That's the best case scenario that I would look at today if I was even going to be involved after having such a great week. But I want to bring your attention over here to the ES. And what you see here is this yellow line is the 200-day moving average. What you see here in the red line is the 50-day moving average, and you can see how they're coming close to each other. They're still quite a bit away. They're a little bit more, close to around 30 points away. But these are going to cross. They are going to cross, and when the 50-day crosses above the 200-day, everybody and their mother knows that that is a bullish signal, and that, time-wise, considering where it is, up here you're at 39.84, you're at 39.30, you're around 50 points. This should take place later next week, most likely right when the FOMC meeting happens on February 1st. So we're getting a cross on the 50 and the 200-day in the very near future. So again, if anybody's still watching, Tesla looking here at a 15-day, great move, great trend line hold, see no reason to be bearish whatsoever. Apple, you can almost see the exact same trend line, the exact same move. Yes, zoom in, very bearish looking bear flag wedge pattern. But again, with earnings coming, absolutely no reason I would be anywhere involved in getting into a short. Netflix, this was your Netflix earnings report. A little bit of a dip right down to that trend line, which comes from way back in 2016 and almost filling that gap from back there in April of last year. Again, didn't break out to the 400s like I was hoping for. Netflix is a great example as to why I don't play the earnings. It's just 252 trading sessions in a year. 4 of those are going to be earnings days. I see absolutely no reason to be involved with it. Google is going to be one of the first ones to hit my 2018 or my 2023 target. Google's up here with new 5-day highs and almost coming up to my 100 minimum, and still way, way shy of that 2017 highs line, which was coming across off around 2018, where we topped out. Google was having its little 5-year consolidation package. Amazon, again, great move this week. Boom, through that 50 retracement at 95, 50 retracements to all of its lows, 50% from the all-time highs, right to that big 2020 open. And here it is, just holding that 93 level. Long, long way to go for this to get up to 116, 120. And just miraculously, again, how it just came right off the COVID lows just over 2 weeks ago. It's a video game, people. It's nothing but a video game. Look really quick here at NVIDIA. NVIDIA, again, no reason whatsoever that I would see anybody being bearish. Still very shy of that 227 target that I've got for this year, but a lot of room on NVIDIA, and this is going to blow your mind because there's too much detail. But yeah, that 193 gets broken, and we're dead set on path for 227. And where will we go? We'll drop over here to 15 days. And the last one I will bring up for you is the VIX. Did it type in? Didn't type in. VIX. Come on, keyboard. Type it in. VIX. We got that move to 2102. A little bit of a gap here still from over the weekend. And that 1811, I'll be very honest with you here. We break down below 1811. And we're going to be on the course of the VIX having to do another reverse split, which it hasn't done a reverse split in, I believe, 4 years, maybe 5 years. I don't remember when the last reverse split was, but that's what the VIX is a product of. The VIX is an actual product that is made to decay. It's made to go lower. And 2102, we hang below it. We start pushing back down to 19 and 18. The bulls have made another step into the right direction so that they can be looking towards that big earnings report that we get next week from all the major tech companies, and heading into the FOMC meeting and heading into Valentine's Day for the CPI, and the pathway to 4,200, 4,300 lays in front of us. Have a great Friday.